Hello everyone, today I will be talking about gratuity, an important employee benefit in India. We'll go through three aspects: the regulatory framework, accounting requirement, and the role of actuaries in gratuity valuation. So let's start with first regulatory aspects in India. Gratuity in India is governed by Payment of Gratuity Act 1972. It is statutory retirement benefit paid to employees as token of gratitude for long and continuous service. Eligibility: any employee who completes 5 years of continuous service with an organization having 10 or more employees is entitled to gratuity. The benefit is typically calculated as gratuity equal to 15 by 26 into last round salary into years of service. Here, 15 by 26 represents 15 days salary for every completed years of service. There is also a ceiling as per latest amendment 2018. The maximum gratuity payable is rupees 20 lakhs. It becomes payable on retirement, resignation, death, or disablement. In case of death or disablement, the 5 years service rule does not apply. Second, accounting requirement. From an accounting perspective, gratuity is treated as post-employment defined benefit plan under Accounting Standard 15 in India and Index 19 for companies following IFRS based standards. Employers cannot just record gratuity when paid. They need to account for future obligations today by recognizing present value of obligation, fair value of plan asset, if any, net liability or asset on the balance sheet. Each year, the employer must also recognize service cost, means benefits earned by employees during the year, interest cost, unwinding of obligation, and actuarial gain and loss, changes in assumptions like salary growth, discount rate, or mortality rate. Disclosure is also very detailed. Financial statements must explain assumptions, methodology, and movement of liability. So essentially, gratuity moves from being just promise on paper to quantified liability in the company's books. Now, third aspect, role of an actuary. Here comes the role of an actuary since gratuity depends on future salary, service years, mortality, and discount rates. It cannot be guessed, it needs scientific valuations. Actuaries help companies by projecting future liabilities, means estimating how much gratuity will be payable in the future using actuarial models. Second, discounting to present values, applying an appropriate discount rate usually based on government bond yields. Third, assumption setting, making assumption about salary escalation, attrition rates, and mortality tables. Fourth, providing AS 15 or Index 19 reports. These reports are mandatory for auditors to certify accounts. Fifth, advising on funding policy, whether to keep gratuity unfunded or fund through approved gratuity trust. So, in short, the actuary plays a key role in ensuring compliance, fairness to employees, and transparency to shareholders. To summarize, gratuity in India is not just a retirement gift. It's a regulated benefit under the Payment of Gratuity Act 1972. From an accounting view, it creates a defined benefit obligation that must be recognized and disclosed. And actuaries act as a bridge, converting uncertainty into numbers and ensuring companies stay compliant. Thank you.